Mutual Fund Show. I'm Neeraj Chan. Over the next 20-25 minutes, we'll talk all about mutual funds. Now, the success or the failure of a fund manager would largely be determined by how she or he generates alpha over the benchmark. Could the same be applied to you and me as individual investors, wherein how do we generate alpha? And are there some natural advantages that you can have if you study the past history of mutual funds to figure out which are the categories which could actually be inclined or designed to generate alpha over others? Well, this sounded very interesting to me when Feroze Azeez told me about it, and therefore we asked him to come in on the Mutual Fund Show to talk about this very aspect. Feroze, great having you. Thanks so much for joining in on the Mutual Fund Show. It's the first time we are having you. A great pleasure.
Likewise, Neeraj. I think like you said, the value created in terms of getting the right category and generating alpha, and the entire premise why you pay a fee is the alpha which the fund manager generates for you. And if you can increase the odds by a deeper study, it's well worth it.
Yeah, increase the odds. That's the term that I was looking for. Thanks for bringing that. Now, Feroze, what gave you the thought of trying to do this study in this particular fashion?
See, the thought was the conventional mindset. It occurred to me when I had actually joined this industry, and some senior actually told me that you have 30% in mid cap, 70% in large cap. And when I was discussing almost after 2 decades with somebody, and the other person proposed the same exact thing. One is you have something which is your backdrop in which you've learned. So conventional mindsets don't change as a behavioral aspect of investing. That was the trigger. Okay. Then we looked at, if large caps have to be 70%, 30%, is this the right ratio which can remain static for 20 years? May not be. That's point one of research. But we will be speaking of the second point today, which was a byproduct of that instigation from that conversation. The byproduct was, before 2018, large caps were synonymous to large cap funds because there was no specific categorization and clarity of what the fund manager can do. They could do a lot more in all categories, or there was no specific bifurcation. So there comes the study, which says that you can actually have 70% large cap without owning one large cap fund from the category. Because if that is possible, then it doesn't imply that you don't have a large cap fund. It implies that it gives you the freedom to choose the funds as per the probabilities and still have the desired large cap, mid cap, small cap allocation, which is the derived exposure from your allocations.
Embedded in this belief or embedded in this hypothesis, Feroze, is that large cap funds, especially post the SEBI categorization and the rules that they put in place for large flexi cap, mid cap, small cap funds, is it embedded that large cap funds haven't necessarily managed to generate the desired return / alpha since that happened back in 2018 or 19 or thereabouts?
See, the good part is they've generated alpha. Our jobs are, as investors or advisors, to try and see, can the quantum be better? Now, if you have 14 large cap funds upwards of 1,000 crores, fortunately last year, they generated alpha over their benchmark as an average of 2.5%. Generated an alpha of 1.5% on Nifty. But having done that, they were still the last category, the 10th category. And 1 year is not good enough. For the lack of time, I'm giving you 1 year data, does not imply that that's data enough to come to inference and derive an action. But if the last category has the largest AUM, it is ironic, is the point being made.
Yeah, so when I looked at the data, it was pretty interesting. And yes, it is 1 year data, but it's pretty interesting that how it is actually small cap as a category, dividend yield, focused funds, and to an extent multi-cap funds, which have managed to outperform the benchmark by a wider margin, or give the maximum bang for the buck. Is my assessment correct?
Yes. For this particular year, small caps have done brilliantly. See, of course, we can brush this aside by looking at the extra return which the mid cap and the small cap as a category also did in the market, in the capital market. Now, the good part is these small cap funds have beaten their own benchmarks as well because it's a larger canvas. Small caps are not so straight-jacketed that you would not find good ideas beyond the benchmark. In large cap, you will find not too much outside the benchmark, which will create more alpha. So benchmark hugging is far more in the large cap. Now, if you look at any fund, the top 10 funds of the country, you would see 85-90% intersection with the benchmark, right? That's benchmark hugging. In a small cap, in spite of their benchmark, because small caps are a larger tail, you will have a headroom of looking at ideas beyond the benchmark.
Right. And Feroze, just one quick follow-up before we get into the granular details as well. One swallow does not a summer make, and therefore you're right that 1 year may not be the exact representation. But even though we're not presenting it on the show, do you reckon that there is a probability or a high probability that it may have occurred in the past as well, that forget alpha over benchmark, but in absolute returns or maximizing returns over a period of time, small caps, flexi caps, multi caps would generally have a larger probability of giving higher returns compared to large cap funds any which ways, after the categorization has been done at least?
Yes, I think so. But they come with their extra risk. So to answer your pointed question, 1 year, last year especially, is not data enough. Point one, I agree. Point two is, can small caps generate long-term extra return in absolute terms? The answer is yes. Does that extra return come to you for free as an investor? The answer is no. If so, what's the extra risk is the next obvious question. Let me preempt that and answer it. A risk is, unfortunately, in our world, at least the wealth management world or investor world, is an English nomenclature, which we don't subscribe to. So it has to be a numerical nomenclature. There is second decimal measurement. So if I gave you some signs of 3-year rolling standard deviation for a large cap fund is between 13.5 to 14. For a small cap fund is between 17 to 19. Okay, that's the dispersion of risk. Is that too much? That's a 30% extra risk if measured in standard deviation. The concept, but the word looks intimidating to any viewer, but it's actually not as intimidating as if you go to the concept of it.
Okay. So therefore, for the future, and then would love to get into some details of some alpha generated by some funds over the years as well. But I'm just trying to understand, Feroze, would you believe that for your own personal portfolios or for the portfolios of the clients that your firm might be advising as well, if they have a slightly longer term horizon, and if they are not averse to digesting a little bit of volatility as well as taking a little bit of risk, then for maximizing returns, would it help the viewer or the investor to have more exposure, or is tilted towards the well-performing funds of the last 12 months, well-performing categories of the last 12 months, if you will?
Yes, Neeraj Saab. To answer your pointed question, the answer is yes. If you have an extended time frame, you can actually have a larger exposure to small cap. Okay, let me put some numbers to it. The 3-year standard deviation, which says on a 3-year basis, the difference is 30%, as against large cap, assuming 14, small cap is 18. In the order of magnitude, I'm saying 4 upon 14 is close to 30%, right? If you compare, again, apples and apples, and look at 5-year standard deviation of returns on a large cap fund and small cap fund, returns of the small cap fund are higher. The difference in risk now falls to 15%, not 30%. So mathematically, the hypothesis that if you have a longer time frame, a small cap fund can give you the extra return, and if you had the courage and the emotional acumen to put it in a box and not be too worried about the short term, then definitely I subscribe to what you say.
And viewers, investing is all about that. Don't necessarily get in only for the 12 months. And if you want to get in 12 months, maybe equity funds are any choice, not the product that you should be looking forward to. Feroze, before we get to the funds again, sorry, I've made this 3 questions on a row now before we get to the funds, but just wondering, for somebody who's, how do I say, there is no one size fits all, I agree. But for somebody, think of an average investor who's between 30 and 60, moderately risk-taking, moderately risk-averse, and indifferent about the equity versus debt part of the portfolio, but wants maximization of returns. What's the ideal percentage, if you will, based on the study that you guys have done and presented to us? What's the ideal percentage of the portfolio in small cap funds, in mid cap funds, in multi cap funds, and if at all large cap funds?
Yes. So firstly, if you look at what should be the percentages should not be as per category. Okay, percentage should be as per market cap. If you bought 10 schemes, okay, you may buy only one small cap scheme for 5%. Okay, optically it'll look like you have 5% small cap, but the derived exposure in the schemes which we have chosen for 2022 is 17%. But optically you will only find 5%, right? So it's very, very important, especially in the newer way how mutual funds are designed, to look at derived exposure. Now comes the question, how will a retail investor understand the derived exposure, right? So you don't have to customize your mutual fund portfolio to the second decimal. All of us need not have separate portfolios. We can all have same equity mutual fund portfolios and calibrate the risk using asset allocation. I have the same 10 schemes with my smallest client and the same 10 schemes with my largest clients across 7,000 HNIs. But the smallest client might have 80% in equity. My largest client might have 20%. So risk is calibrated using asset allocation. The underlying schemes may not change. The benefit of that is then all of us following the same 10 schemes gives the power of research a huge boost. Right? That's how we look at that whole statement of one size fits all. I might have 20% of my money in equity mutual funds, but it will be the same 10 schemes as somebody who has 70% of his money in equity mutual funds.
Got it. Okay. Now, so that's an important clarification. And viewers, I hope you understand. Even if you don't follow what Feroze is saying to the T, because your thesis might be separate, and it's great to have your own thesis, by the way, if you are actually studying markets and mutual funds on a daily basis, so to say. But the idea of you having some large cap and some small cap exposure when you have a flexi cap fund or a multi cap fund is there. So even if you have 2 small cap funds and the total is only up to 80% of your portfolio, but if you have 10 other flexi cap funds, and if there the small cap exposure rises, then your actual small cap exposure is much higher than the 8%. I think that's the point that Feroze was trying to make. And it's a powerful thought. I think all of you need to look at your portfolios and try and figure that out accordingly. It's an important message. Feroze, thank you for that. That's a really important message. Now, may I request you, Feroze, to get on to something that you have given us, which is some funds that you guys have looked at, which have, and you've tried to capture the alpha generated by some of these over the years. Can you talk a bit about that?
Sure. For the discussion purpose, we've chosen 8 schemes. How we choose these 8 schemes has 2 basic fundamental principles, which we have evolved over the last decade in terms of research of how do you choose them. The choice might be different, but the method of choice has to be consistent. So we give 50% weightage to something called predictive analytics. Interesting concept. Why am I saying this? So that there's credibility to these 8 schemes. So there are 11 parameters which are statistical parameters, which have a better predictive capability. And that is statistically established. So past performance is not a great indication of the future, is what we hear in mutual fund advertisements, if we are able to, because they're very, very fast and swift when they say that. We tried that statement by research, and we found out actually past performance is not a great predictor of the future. If I choose 10 best schemes of last year, only 2 of them remain best in the next year. This study actually proved that statement. So we looked at 11 other parameters, which were statistically established, which have a better predictive capability, because your returns are in the future. You buy today and hope for a great performance in the future. So that gets 50% weightage. The other 50% weightage is given to target NAV. If you have to choose mutual funds for somebody, you also need to have the capability of choosing stocks. So we have an analyst team which gives targets to each stock and in turn get a target NAV for each of the funds in question. These two get 50% weightage. And that's when these scheme choices come. Sorry, it's a long story. I was just trying to build credibility to why you should look at these schemes if you so chose.
Yeah, no, Feroze, I must confess that at some point of time in the near future, we would love to do a show separately on this very aspect, because it will be amazing for people to understand a way in which you guys are choosing funds. Some of them could try and do it themselves as well. But I'm just trying to understand that, therefore, the choice of some of the funds are getting done in 2 ways. One is the looking at the category and whether you should choose the fund. You mentioned that don't choose funds via the category, but choose via the market cap, so to say. But also the category study would probably give an idea that you should try and restrict your exposure to a particular category up to a particular percentage and increase in some other, right?
Correct. Absolutely. That study helped us shed 2 large cap funds and still have 51% in large cap, 33% in 32% in mid cap, and 17% in small cap. That's the derived exposure, but there's only 1 large cap. Of course, it's a show content in itself for how do you choose schemes. But the good part is, if you don't look at the rear view mirror, you will buy schemes, or at least your chance of buying schemes which are at the trough. Like last year's choice, there were 2 schemes which we chose last year, which were very bad performers: Franklin Blue Chip and HDFC Flexi Cap. On the basis of the target NAV, they turned out to be the best ones, but they were very bad performers for 4 years. So coming back to your point, if I have to give a category preference, Flexi Cap is a great category because it still has 80% in large cap, 75% average is currently in large cap of all Flexi Cap schemes. Large cap, you can have 1 scheme, 1 Flexi Cap scheme, 1 multi-cap scheme, 2 mid-cap schemes, 1 small cap scheme, and 1 contrast. This is the current category-wise number of schemes you should choose as per category.
Okay. And Feroze, my final question on this, and of course, we are going to do, like I said, a separate show on this whole construct mechanism as well. But I'm just trying to understand, how do you get the confidence, for example, to choose a fund, like, for example, the Franklin India Blue Chip Fund? I'm presuming it's a part of your recommended portfolio. It's had, unless I'm understanding these numbers wrongly, compared to the alpha benchmark, a negative for 3 years on a trot before turning out a positive number in 2021. So what goes behind the confidence of choosing a fund for one particular year?
So it was in Franklin's case, if you looked at in 2021, which we did in December 2020, January 2021, 1 year back, we saw that the constituents of the portfolio had the best target NAV. It was the best target NAV. It had a headroom larger than the great scheme. So that's basically saying that if a portfolio has already lived its course, people end up rushing to buy it, and nobody has the courage to buy something like that. So every year you check that. So again, we checked it this year. It still has a headroom of a 3-4% alpha over Nifty over the next 1 year. So that still continues to be a recommendation. It need not change every year. If circumstances do, then it does.
Got it. Yeah, NHS. Yeah, I missed the point that the bedrock of this whole thing is the target NAV which you do. So it'd be lovely to understand that concept on another show as well, Feroze. But for this show. The takeaway, very, very powerful. And thank you so much for sharing it with us. And thank you so much for being a part of the show today.
Thank you, Neeraj. Thank you so much to have me.
Pleasure was ours. Viewers, thanks for tuning in to this leg of the Mutual Fund Show.